Hello friends, if I tell you that losses are good for you and it can actually help you save taxes on the profits which you make in the share market, will you believe me? No, right? But yes, this is actually true, and in this video I am going to explain you how you can do this. So watch this video till the end. Hello friends, my name is Karthik and my mission is to spread the knowledge about the world of commerce under one umbrella, which is Combrella. So friends, let us understand some basic concepts before going deep into the video. There are two important terms which you should know in the share market: short term and long term. If you buy shares or mutual funds and sell within 12 months, that is 1 year from the date of purchase, it is known as short term. So if you sell for profit before 1 year, it is known as short-term capital gain, STCG in short form. And if you sell for loss before 1 year, it is short-term capital loss, STCL. Similarly, if you buy shares or mutual funds and sell after 12 months, that is after 1 year from the date of purchase, it is long-term. So if you sell for profit after 1 year, it is long-term capital gains, LTCG. And if you sell for loss after 1 year, it is long-term capital loss, LTCL. Okay. So now let us go to the second concept. Now as per section 70 subsection 3 of the Income Tax Act, if you have long-term capital loss, you can adjust with long-term capital gains. And if you have short-term capital loss, you can adjust with short-term capital gains and long-term capital gains. So basically, long-term capital loss, LTCL, can be adjusted only with STCG. But short-term capital loss, that is less than 1 year loss, can be adjusted with both short-term capital gains and long-term capital gains. Okay. So now, how does this set off work? Okay. First, I will give you one simple example in a layman's language, and then I will give you a technical example also. Okay. Suppose you sold shares of one company for 30,000 rupees profit. Okay. Now, as of now, leave long term and short term aside. For the time being, forget long term and short term. Okay. Just assume that you sold shares of one company for a profit of 30,000 rupees. Okay. Now, you also sold in this year shares of another company for a loss of 15,000. Okay. So, one company's shares you sold for 30,000 profit. Another company's shares you sold for loss of 15,000. So what is your net profit? 30 minus 15 is equal to 15,000 is your net profit only. Okay. And on this 15,000 you need to pay the tax. This is what is known as set off, right? If the set off was not there, what will happen? On 30,000 rupees profit you will pay tax, and on 15,000 rupees loss you will not pay any tax. But because of the set off provisions, you need to pay tax only on the net profit, that is profit and losses net set off together, and you need to pay tax only on 15,000. And friends, this loss can be carried forward for 8 years. That is, this loss, 15,000 loss, which I gave you in this example. Okay, suppose you don't have any profits in this year to set off this loss, right? Doesn't matter, it's fine. You can carry forward for the next year to set off against the profits of next year. Now in next year also you don't have any profits to adjust this loss or to set off this loss. Doesn't matter, you can carry forward for 1 more year. Like this, you can carry forward this losses for 8 years until you set off against some profits. After 8 years, this will lapse. Okay friends, so remember these important points which I have told you. This is the core part of this video. And rewind the video, watch it again to get the concept clear in your mind. Okay. Or else you can also check the description wherein I have given the important terms and the explanation for that. So friends, now let me give you a practical example on how to save taxes. Okay. Suppose you buy shares of one company, okay, some X quantity at X price. Total value which you have invested in the shares of that company is 1 lakh rupees. Okay. Now after 9 months of your purchase, 9 months, which means it is less than 12 months, and hence it is short term. So after 9 months, the value comes down to 80,000 rupees. Now what you need to do is, you need to sell those shares at 80,000 rupees and book a short-term capital loss of 20,000 rupees and buy the same shares again of that same company at 80,000 rupees. Why you are doing this? Because you are convinced that this is a good company, but right now the price is down, but definitely you have good confidence that the prices of the shares of this company will go up in the future. That's why you are buying the shares again at 80,000 and you are booking a short-term capital loss of 20,000 so that you can adjust with the gains of some other company. Okay, so remember this, you have booked the short-term capital loss of 20,000 and keep this in mind as I will be using this many times in the video. Now, what you need to do with this short-term capital loss of 20,000 is, suppose in this year itself, you got short-term capital gains of 50,000 rupees from sale of some other shares. Okay, possible? Now, you need to adjust this short-term capital loss of 20,000 with the short-term capital gain of 50,000, and then what will be your net short-term capital gain? 50 minus 20, 30,000 rupees. And on that, pay tax at the rate of 15%, which is 4,500 rupees. That is what is known as set-off. So, if you had not sold the shares at 80,000 and not booked a loss of 20,000, what would have happened? You would have got short-term capital gains of 50,000 and on that you would have paid 15% tax, which is 7,500 rupees. But by booking the loss, your tax is now only 4,500, which is less by 3,000 rupees. This is what is the advantage of booking the losses. Now let me give you a part B of the same example. Let me extend this example. Okay, now suppose in this year, instead of short-term capital gain of 50,000, you got a long-term capital gain of 1,30,000 rupees, okay, from sale of some other shares of the company. Then in that case, what will happen? Okay, up to 1 lakh rupees long-term capital gains is exempt, friends. Okay, that is there. So what is the balance? 1,30,000 minus 1 lakh is 30,000 rupees is the balance of long-term capital gain. Now on this balance of 30,000, you can adjust your that short-term capital loss of 20,000. So your net LTCG is how much? 30 minus 20, which is 10,000, and on that you have to pay tax at the rate of 10%, long-term capital gains tax at the rate of 10%, which is 1,000 rupees. Okay, so if you had not sold the shares at 80,000 and not booked a loss of 20,000, then you would have paid tax on how much? 1,30,000 rupees is your long-term capital gains minus 1 lakh. So balance is 30,000 into 10%, 3,000. But because of booking losses, you are paying tax of only 1,000 rupees and saving 2,000 rupees. Okay, friends. So understand that you cannot utilize this losses, two times. You can utilize this loss only one time. The short-term capital loss of 20,000, either you can utilize only this 20,000 you can utilize only once, either with STCG or LTCG or with both, but you can utilize 20,000 only. You can utilize 20,000 once with LTCG and 20,000 again with STCG. No, you can utilize only once. That you have to know. Okay. Now the thing which I told you can carry forward for 8 years. Assume in this year you have got a loss, right? Not assume, you have got a loss in this example of STCL 20,000, but you don't have any gains, long term or short term. Doesn't matter. Carry forward these losses of 20,000 STCL to next year. Now in next year also you don't have any gains. Doesn't matter. You can carry forward for one more year. Like this, you can carry forward for 8 years until this STCL of 20,000 is adjusted with the profits of some other shares, and after 8 years only this will lapse. Okay, so that is the advantage of tax loss harvesting. Okay, friends. Now, in this example, I have taken a short-term capital loss of 20,000 and hence I can adjust with short-term capital gains and long-term capital gains. But suppose instead of short-term capital loss, if you had long-term capital loss, what happens? Let us now look into the example of that. So friends, now let us go to scenario 2, which is long-term capital loss. What happens in that situation? So in this, let us take an example. Same example, you bought shares for 1 lakh rupees, okay? But now after 1 year, after 12 months and hence it becomes a long term, the value of those shares is now 80,000 rupees. What happens now? You need to sell the shares for 80,000 and book a long term capital loss of 20,000 and again buy the shares at 80,000 rupees. Now this long term capital loss of 20,000 you can adjust only with long term capital gains, which I have told you already in the beginning. So in this case, suppose in this year you got long term capital gains of 1,50,000 on sale of some other shares of the company. Then what happens? Up to 1 lakh long term capital gains is exempt. Balance is how much? 50,000. This 50,000 you adjust with long term capital loss of 20,000. So your net long term capital gains is 30,000. And on 30,000 you need to pay long term capital gains tax at the rate of 10%, which is 3,000. Now what would have happened if we had not sold the shares at 80,000 and not booked a loss of 20,000? Then in that case your LTCG would have been 1,50,000 minus 1 lakh, okay, which is exemption available, which is balance available is 50,000 rupees. On that you would have paid tax at the rate of 10%, which is 5,000. But because of booking of losses, your tax is now 3,000 instead of 5,000 and hence you are saving 2,000 rupees in taxes. So friends, this long-term capital loss of 20,000, suppose if you don't have any long-term capital gains in this year also, then it is fine. You can carry forward this long-term capital loss to next 8 years to set off against the profits. Okay, so even if you don't have profits in this year to set off the long-term capital loss, that is you don't have LTCG, you can carry forward for 8 years similar to short-term capital loss. So basically both short-term capital loss and long-term capital loss you can carry forward for 8 years in the future to set off against the gains. Okay, so friends, this tax saving hack or this tax saving technique is very simple. You watch the video again slowly and then I'm sure you will get more clarity and understanding. Okay, keep this core point in your mind, which is long-term capital loss can be adjusted with only long-term capital gain, and short-term capital loss can be adjusted with short-term capital gains and long-term capital gains both. Okay, and one important point which I want to tell you in the end is use this technique only when you can save considerable amount of taxes. Okay, when the tax savings amount is considerable for you. Don't use this technique to save 500 or 1000 rupees of taxes. You can still use it, no harm, but then you will have to keep a lot of documentation, track record of which shares you bought, when you sold, okay, what is the quantity, buy quantity, sell quantity, price and all those things. You have to keep a lot of track record, which is not worthwhile if you're saving only small amount of taxes, and hence use this technique when the tax savings is good enough for you, right? So with that, we come to the end of this video, friends. I hope you all found this tax saving hack technique useful for you. So do apply it in your practical life if you found it useful. And thank you for watching this video. I will see you all in the next video. Until then, this is CS Karthik signing off. Thank you and namaste.